when you look at study unit 3, if you check in the study guide that the lecturer would have sent you, you see that study unit 3 is the one that looks at covering managing an individual investor portfolio. So when you look at managing individual investor portfolio, they are basically their outcomes that they ask you to be able to achieve under that under that section, which is the chapter 2, where they say you should go through chapter 2, and there are different outcomes that they ask you to be able to understand and go through when it comes to managing individual investor portfolio. And this question of of preparing the investment policy statement, especially for individuals, is a very important concept because it's a highly examinable concept as well. So you see that if you go to chapter 2, which looks at managing individual investor portfolios, going back to what we did in chapter 1, remember we said chapter 1, we looked at overview to see exactly how do you manage a portfolio of a particular investor as well, where we looked at this process that needs to be followed in when it comes to managing the investment portfolio of a particular investor as well. And then we also look to see exactly when you're now looking at the first step where you're looking at gathering the information of the client, then the idea behind that is that you need to be able to actually prepare the investment policy statement. And in preparing the investment policy statement, there are certain objectives and also constraints that you have to take into account when you're preparing the investment policy statement for the client as well. So chapter 2 now goes on further. The main thing that you're going to be taking note from chapter 2 is that you're going back to the creation of the same investment policy statement, but now you are now going to specifically look at preparing the investment policy statement for what? For an individual investor. Then you see that in chapter 3, which is going to be the next study unit that we're going to be looking at, we're going to be looking at what? Managing institutional investment portfolios as well. And in this, for institutional investors, you're now going to be looking to see exactly how do you prepare the investment policy statement for what? For an institution. But the one that is more highly examinable under normal circumstances is basically this one, because the lecturer loves to ask the concept of managing in individual investor portfolios as well. So looking at this, under introduction, on line number 2, okay, on paragraph number 2 under introduction, they say private asset management has only recently begun to receive a greater attention from the academic community and financial press. So in contrast to large tax-exempt institutional portfolios that are typically assumed to operate in perpetuity, the universe of private investors is heterogeneous. And when they say heterogeneous, it basically means that it's different. It's basically different all over the place. And the burden is burdened by taxes and less well suited to the simplifying assumption of modern financial theory. So it's heterogeneous in the sense that different clients are going to be coming up with their own needs and different own objectives and constraints that are going to be affecting them as well. That's why they say it's heterogeneous. And also it's burdened by taxes, mainly because there are different tax treatments for different individuals. That's why you see that people in different tax brackets are going to be treated differently when it comes to the tax rates as well. Then there's less well suited for simplifying assumption of modern financial theory, mainly because because of the high customization of the preparing of the needs of the different investors. There, it's difficult to now have a particular financial theory that can be able to actually explain all these different investors because of their different and unique circumstances as well. So they say individual investors have diverse investment objectives, time horizons, and perception of risk, all subject to tax schedules that have varying degrees of stability and logic. Then if you go to page 21 of the second paragraph, they say, with the help of a case study, this chapter examines the portfolio management process for individual investor. And remember, the case study that we're going to be looking at here is the case study of the family, which we call the Inga family. Then I'm going to give you time to go through that particular case study as well. So before we go on to understanding how to prepare the investment policy statement, we need to go through the information that is relevant for the family that we're going to be analyzing. In this case, it's called the Inga family. So if you check under section 2, where we look at the case study, they say Victoria Jordan CFA works for an investment firm that manages private client accounts. Both Jordan and the Inca family reside in a politically stable country whose currency trades at a fixed rate of 1:1 with the euro. Both real gross domestic product and growth and inflation are average about 3%, and resulting in a nominal annual growth of what? Approximately 6%. Because remember the saying, in this case, your nominal rate of growth is basically given as your real rate of growth of 3% plus inflation rate of 3%. So 3 plus 3 gives you a nominal rate of growth rate of what? Of 6%. That's where the 6% is coming from. So here they say the country in which the Ingas reside maintains a flat tax rate of 35% of all personal income and a net capital gains of 15%. Then they say, with no distinction between short and long-term holding periods, also incorporated into the tax code is a wealth transfer tax. So any asset transfer between two parties, whether it's a gift or family inheritance, is taxed at a flat rate of 50%. Then they are also saying that if you check on the question on the case study, if you check on line number 2 from bottom of that case study, they say the RSA investment return. So they're basically saying that they're also having an investment in a what they call the RSA investment, and they say the RSA investment returns are exempt from taxation, and participants who may begin by making tax-free withdrawals of any amount at the age of 62. So which means that whenever they're going to be investing in this RIA type of investment, they are going to be able to access their money tax-free if they are going to be from the age of 62 onwards as well. Then looking at the family as well, they're basically saying that the family, this is where you find the husband being Peter and the wife being Hilda, and they've been together for a period of 37 years. And they have 2 children together, Krista and Hans. And Krista is 25 and Hans is what? 30 as well. Then they also give us other important information where they say Peter Inga is 59 years, is a successful entrepreneur, and he's got his own company. And then they give us this information. I'm just going to give you the gist of information that we need for us to be able to answer the question. Then what I'll give you another few minutes or so to just go through the information that they have on the case study as well. Then on this particular case study as well, they are basically saying he is already evaluating 3 separate bids that indicate, so which means that he wants to sell his business so that he retires. And when he's separating, evaluating his business, there are probable proceeds of net of taxes on gains of approximately 55 million euros to the Inga family in total. So he's expecting, if he's planning to retire very soon, and when he retires, he wants to sell his business, and he's estimating that currently he can be able to sell his business and earn about 55 million from the selling of his business as well. Then they also say Peter believes that everyone in his family is financially secure and wishes to preserve that security. He recognizes that the family's needs for coherent investment plan. Then they say, remember we said Peter is 59, his wife Inga is 57 years of age, and here they say throughout her lifetime, the trust so here they say comes from a wealthy family. Since her marriage to Peter has been she has been a housewife and mother to Krista and Hans. So Hilda is the beneficiary of a trust established by her family. Throughout her lifetime, the trust will distribute to her an inflation-indexed annual payment of 75,000 euros, which is taxed at a personal income rate as well. So at her death, payments will stop and the trust remaining assets will be transferred to a local charity. Then they also give us information about the daughter, and the way they say the daughter is a son who's 5 years old called Jürgen. And then they also say is the other son is currently not married at the moment as well, and doesn't have a family. Then they give us the list of assets that the list of assets, and they also give us the income data and also the personal assets that the family also owns as well, apart from the business that they currently own as well. So they give us this list of assets, and then they also give us the list of assets for Inga and for Peter, and they give us the list of assets for Krista as well. and what their interest is in the particular business at the same time. So can you quickly go through the information that we have on this case study? Then what we'll do is that we are now going to go through to see exactly how would you be able to prepare the investment policy statement for this family based on this particular case study as well. So can you please quickly go through the information from section 2.1. Next thing that we need to take note of when it comes to this particular case study as well is the financial the financial advisors findings when it comes to the personality types of the different family members as well. So if you check under they give us the different personality types of Peter, then they also give us the personality type of Hilda, Hans, and Krista as well, right? So we are going to be looking at these in detail when we are going to be looking at the different personality types that we're going to be setting to each individual as well. So we're going to come back to this after we're on the next session when we look at the personality types as well. So the next section, which is the third section of the chapter, we look at investor characteristics to find out exactly, so how do you determine the different characteristics of the different investors so that you're able to understand how they think and exactly how much risk they're going to be able to take as well. Remember, what we discussed last time, we said when it comes to the different types of investors, they also come in with the different, when you're preparing the investment policy statement. So the idea in the preparation of the investment policy statement is for you to be able to address these different objectives and what constraints as well. When we say that the objectives would be the risk, the return objectives, then the constraints you are going to remember we said it's RRLLTTU, isn't it, right? Where we say that when it comes to the constraints now, you're going to be having what? The liquidity issues. You're going to be having the legal and regulatory issues. You're also going to have the time constraints. You're also going to have the tax issues. And then you're also going to be having what? The unique circumstances as well. So these are the issues that you need to be able to address when you're looking at the preparation of the investment policy statement. And remember, we said for the investment policy statement, these are objectives that the investor would want to be able to achieve. And these are the constraints that the investor, that can also constrain the investor from being able to achieve what? Their objectives or their goals of the investment as well. So when we're going to be looking at the preparation of the investment policy statement for the Inca family, our target is to be able to address these issues as well. But remember, in addressing these issues, we're not going to be looking in depth to say, ideally, based on the case study that we're going to be looking at, how are you going to be able to address and analyze each the family as a whole as well, or as individuals. So if you check in the study guide, so if you check in the textbook, they are under investor characteristics. They on section 3.1, they look at finding the investor characteristics through situational profiling. So one way of finding investor characteristics is through situational profiling, where they say many useful attempts have been made to categorize individual investors by stage of life or by economic circumstance. So such situational profiling runs the risk of oversimplifying complex behavior and should be used with a measure of caution. So individual investors are unique and likely to exhibit characteristics that cut across arbitrary lines of categorization as well. So one way of using situational profiling as a way of actually categorizing the different investors is through analyzing the source of wealth, where they say some classification schemes presume that the manner in which an individual investor has acquired wealth offers insight into the investor's probable attitude towards risk. So successful entrepreneurs such as Peter Inga have created their wealth by personally taking business or market risk, is assumed to exhibit a higher level of risk tolerance than those who have been more passive recipients of wealth. Then if you go to the next paragraph, they also say, in contrast, more passive recipients of wealth may be associated with a reduced willingness to assume a risk as well. But remember, you have to use this with a measure of caution, mainly because sometimes some investors, they can be they will be self-made, they would have made their own wealth, but at the same time, whatever they would have accumulated there, they won't be that willing to actually take risk on that wealth that they would accumulate it as well over time. So you have to make sure that you're able to actually take caution. So you need to know that you can also use a source of wealth as a measure to see exactly, to try to estimate, to see what is the estimated willingness of the investor to take risk. Because remember we said, when it comes to the issues of risk, you have to check to see what is the willingness of the investor to take risk, and you also have to check to see what is the ability of the investor to take risk. Then after you check the willingness and you check the ability, that's when you can now look at the overall risk assessment of the investor as well. The next one is measure of wealth. And here they say, given the objective nature of financial well-being, it is difficult to categorize investors based on the portfolio size. So here they say, a portfolio that one individual considers large and able to meet future needs may be insufficient in the eyes of another individual. So all the same, it is not unreasonable to consider that investors who perceive their holdings as small may demonstrate lower tolerance for portfolio volatility than those investors who perceive their holdings to be large as well. So we're basically saying that when you look at the measure of wealth, generally, although you have to use some measure of caution there, the general assessment is usually that when an investor considers that their wealth to be quite big, it basically means that it's usually associated with higher willingness to take risk. And if their portfolio is considered to be quite small, it is usually considered to be associated with a lower willingness to take risk as well. Then another issue that can also be used when it comes to situational profiling is the stage of life, to say in which stage of life is this particular individual. Are they at the beginning of their life, or are they in the middle, or are they towards the end of their perceived life as well? So if you check on page 26 on section 3.1.3, on line number 5, they say, of the first paragraph, they say, for the sake of illustration, an individual's investment policy can be viewed as passing through 4 general phases: the foundation phase, accumulation phase, maintenance phase, and the distribution phase. So these are the assumed stages in which an individual goes through their different stages in life as well. So on the next paragraph, they say, they now look at the first stage, which is the foundation phase, where they say, during the foundation phase of life, the individual is establishing the base from which wealth can be created. So this base might be a marketable skill, the establishment of a business, or the acquisition of educational degrees and certifications. So during the foundation phase, the individual is usually young, with a long time horizon, which normally would be associated with an above average tolerance of risk. So risk tolerance should certainly be above average in the foundation stage if the individual has inherited wealth as well. So which means, in this case, please take note that when the person or one individual is considered to be in the foundation phase, this is basically where they are still starting off in life, and maybe they have a marketable skill, they are starting a small business, or they are basically starting off in life as well. Those individuals, because they are considered to be having a long-term horizon until they retire, it basically means that the assumption is that they should generally be expected to be having an average, an above average tolerance to risk as well. So they should be generally be having an above average tolerance to risk. Those individuals in the foundation phase. Then on that particular page, if you go to paragraph number 4, they also discuss the individuals in the accumulation phase. And they say, in the accumulation phase, earnings accelerate as returns accrue from the marketable skills and abilities acquired during the foundation period and gradually reach their peak. So in the early years of accumulation phase, income rises and investable assets begin to accumulate. So here they say expenses are also rise during this period through the establishment of family, purchase of homes, and the care and education of children. So in the middle and later years of the wealth accumulation phase, expenses typically begin to decline as children reach adulthood, education needs are fulfilled, and home purchases are completed. So income generally continues to rise as the individual reaches peak productivity. So if the individual's personal spending habits do not change, the gap between the income and the expenses may widen through the accumulation phase, allowing for an increase in saving as well. So which means in this case, they're saying some individuals may forego investing their growing wealth and instead increase spending on luxury items or perhaps make gifts to relatives and charities. For investors, however, the accumulation phase is characterized by increased risk tolerance, driven by their increasing wealth and still long-term horizon. So Hans is in the 8 years of the phase and is clearly willing to assume high risk to achieve what his wealth and lifestyle goal as well. So which means when an individual is considered to be going through the accumulation phase, they are basically saying that their risk-taking ability is also, it's generally expected to be increasing, mainly because they still have what a long-term investment horizon for them to be able to actually what grow their portfolios as well. Then the next phase that they discuss is the maintenance phase, where they say the individual is moved into the later years of life and usually is retired from daily employment or the pressures of owning a business. Then if you go to the next paragraph, they say, in the maintenance phase, investors will typically reduce exposure to higher volatility asset classes, such as common stocks, and increase exposure to lower volatility investments, such as immediate term bonds. So because the individual now has less time to recover from poor investment results, portfolio stability becomes increasingly important. So in this phase, the challenge is to achieve a desired level of portfolio stability and maintain an exposure to risky investments sufficient to preserve the portfolio's purchasing power. So which means in this case, they're basically saying that when it comes to when it comes to the next stage, which is basically the maintenance phase, they're basically saying that the risk tolerance now is now going to be expected to reduce drastically, mainly because they no longer have that much amount of time for them to be able to recover from any losses from their portfolios as well. So you wouldn't expect them to be having an above average risk tolerance. Generally, you're expecting them to be having an average to below average risk tolerance as well. Then on page 27, they also, on the second paragraph, they also talk about the distribution phase, where they say in the distribution phase, accumulated wealth is transferred to other persons or entities. So for many of these phases this phase begins with the individual is still reaping the benefits of the maintenance phase and retirement. For most, the phase involves a conscious decision to begin transferring wealth. So dealing with tax constraints often becomes an important consideration in the investment planning, as investors seek to maximize the after-tax value of assets transferred to others as well. So which means when it comes to this particular phase, their main issue or their main concern is now going to be the tax issues when it comes to transfer of wealth. And they also now have to take into account to see exactly how much incentive do they have for them to be able to transfer wealth without being taxed. Like, for example, if you look at the case of South Africa, this is where they say, for example, there's a maximum donation of 100,000 that one can make without being taxed as well. So in that case, it basically means that the distribution phase would be becoming very, very important as well. So are there any questions when it comes to the different phases that are used to assess an individual when you look at situational profiling of the different investors as well? Are there any questions so far? So on the last sentence on page 27, here they say the value of situational paradigm therefore lies more in the general insights into human behavior and less in their ability to fully interpret individual circumstances. So you can use situational profiling to try to categorize individual investors, although you have to actually be very cautious when you're using situational profiling to profile individual investors, because it's not all the time that an individual in a particular situation is going to be behaving or in a certain way as well. Another way of profiling investors or individual investors is through psychological profiling. So when you look at psychological profiling, on the first paragraph, under psychological profiling, line number 3 from bottom, they say, psychological profiling, sometimes referred to as personality typing, bridges the difference between traditional finance and what has come to be defined as behavioral finance. And when you look at traditional finance, they say, on the second paragraph, they say, in models of traditional or standard investment decision making, investors are assumed to, one, exhibit what? Risk aversion, which means that they're not willing to take risk unless they're able to what? To take on, to get higher returns as well. Then 2, hold rational expectations. And 3, they practice asset integration. So when it comes to risk aversion, on the next paragraph, they say risk aversion implies that investors with otherwise equivalent investment options will prefer the investment with the lowest what? Volatility. So when it comes to the issue of risk aversion, this is where we're basically saying that this is where we're having a situation where an investor, for the same amount of return, they want to be exposed what? To the lesser risk. So for the same amount of return, they want to be exposed to what? To lesser risk as well. So this is basically what we mean when we look at what an investor being considered to be heavy risk aversion. Then on the next sentence, they say, on the next paragraph, they say, rational expectations assume that investors are coherent, accurate, and unbiased forecasters. So their forecast will reflect all relevant information, and they will learn from their past mistakes. So this is where we say we have rational investors. And next, they say asset integration refers to the process by which the investor chooses among risky investments. So investors practice asset integration by comparing the portfolio return or risk distributions that result from combining various investment opportunities with what? Existing holdings as well. So is there any question when it comes to the traditional finances assessment of different investors, what behaviors there as well? Is there any question when it comes to the psychological profiling under traditional finance assessment? The second one is behavioral finance. And here they say, a growing body of research points to differences in behavior caused by differences in how individuals approach uncertain situations. Then if you go to page 29, on the first paragraph, on the last sentence, saying, these decision-making models attempt to incorporate the principles of behavioral finance in which individual investors are recognized to, one, exhibit loss aversion, hold biased expectations, and practice asset segregation. So with loss aversion, they're basically saying loss aversion is demonstrated when investors evaluate opportunities in terms of gain or loss rather than in terms of uncertainty with respect to terminal wealth. So first, with the choice between one, a certain loss, and two, an uncertain outcome that might produce a smaller loss, but whose expected value is a larger loss, investors are likely to exhibit loss aversion by choosing the uncertain alternative, because they don't want to be having a situation where they are certainly going to be experiencing what? A certain amount of loss as well. Then on page 29, on paragraph number 4, they also discuss the way they say the investors also hold biased what? Expectations. And here they say biased expectations result from cognitive errors and misplaced confidence in one's ability to assess the future. Then on the next paragraph, they say they also, this is where they also look at another category. This is where they say the investors, they practice what? Asset segregation, where they say asset segregation is the evaluation of investment choices individually rather than what? In aggregations, which means that you're basically, when you look at asset segregation, this is where they're basically saying that investors generally, they assess each investment on its own than assessing overall investments what in a portfolio. So which means that they are likely to assess investments. So if you're having a portfolio of investment A, B, and C, they are not likely to be assessing the investment on the overall portfolio. They are going to be assessing the investments not in individuality, where they're going to say, how is investment A performing, how is investment B performing, and how is investment C performing as well individually. So these are the types of personality behavioral finding. These are the types of what you're going to be finding under what psychological typing when you look assessment when it comes to what behavioral finance as well. The next type of assessment that you can also look at would be personality typing, where they say generally all investors have unique, complex personality dimensions shaped by socio-economic background, personal experience, and current wealth status. So these diverse factors make it difficult to precisely categorize investors into types. So yet, by combining studies of historical behavior with surveys and scenario analysis, we can broadly classify investors into types. So through personality typing, investment advisors can better understand the behavior of drivers that lead to an individual goal setting, asset allocation, and risk-taking decisions. Thus, the advisors can better manage client expectations and behavior as well. So when it comes to the personality typing, this is where they can ask questions to different investors. Then they're now going to be able to put them into different categories as well. So how they gather the information in coming up with a particular personality type for the individual, you're not necessarily going to be worrying about that because they are never going to be asked to do a survey there as well. So they'll give you information in the case, and from the information in the case, they are now going to be looking for the keywords which are going to be used now to do what? To describe a particular personality type. So there are four main categories of personality types that we're going to be looking at. So there are four main categories of personality types that we're going to be looking at. The first one, or the first category of personality type would be, the first category of personality type would be cautious investors. And here they say, when it comes to cautious investors, these are the cautious investors are generally averse to potential losses. Their aversion may be a consequence of their current financial situation or of various life experiences, but most exhibit strong need for financial security. So cautious investors usually desire low volatility investments with little potential for loss or principal. So although these individuals generally do not like to manage their own decisions, they are not easily persuaded by their others, often choose not to seek professional advice. So cautious investors dislike losing even small amounts of money and seldom rush into investments. So they often miss opportunities because of over-analysis or fear of taking action. So their investment portfolios generally exhibit low turnover and low volatility as well. So please take note of these personality types, because we're going to be now going back to the case study and see these are four individuals that we've put in. Which personality type are they going to be falling under as well? So the second one is methodical investors, and here they say this group relies on hard facts. So methodical investors may intently follow market analysts or undertake research on trading strategies. Even when their hard work is rewarded, they typically remain on a quest for new and better information. So their reliance on analysis and database histories generally keep them from developing emotional attachments to investment positions, and their discipline make them relatively conservative investors. Then the next type of investor that we're going to be looking at is spontaneous investors. And here they say, spontaneous investors are constantly readjusting their portfolio allocations and holdings. So with every new development in the marketplace, they fear a negative consequence. So although spontaneous investors generally acknowledge that they are not investment experts, they doubt all investment advice and external management decisions. So they are over-managed, they are over-managers. Their portfolio turnover ratios are the highest of any personality type. So although some investors in this group are successful, most experience below average returns. Their investment profits are often offset by commission and trading charges generated by second guessing and frequent adjustment of the portfolio positions. So spontaneous investors are quick to make decisions on investment trades and generally are more concerned with missing an investment trend than with their portfolio level of risk. So those are the type of so this is the type of another personality typing where you're looking at spontaneous investors. So please make sure that you take note of the different characteristics there of the different personalities as well. The next one, or the last type of personality type, is the individualist investors. And here they say this group has a self-assured approach to investing. Individualists gain information from a variety of sources and are not averse to devoting the time needed to reconcile conflicting data from their trusted sources. They are also not afraid to exhibit investment independence in taking a course of action. So individualist investors place a great deal of faith in hard work and insight and have confidence that their long-term investment objectives will be achieved. So these are the different types of personality types that we're going to be looking at there. Is there any question from the personality types before we go back and try to analyze the Inga family to see exactly which personality type are they going to fall under? Any questions?
Yes, I've got a question.
Yes.
Yes, I just wanted to know, so when you look at the individualistic investor, is he more for conservative or not? From the text, it's not really clear.
Yeah, from they don't necessarily say that they are conservative, but if you look at the information that they have confidence that their long-term investment objectives are going to be achieved. So which basically means that they are not averse to devoting their time to what needed to reconcile the conflicting data and their trusted sources as well. Which basically means that individualist investors, when they take on more or risky investments, they are the ones who are in a better position to actually take on more risky investments. Why? Because they are going to be sticking to the investment philosophy in the long run. So if you compare them with the cautious investors, the methodical investors, and the spontaneous investors as well, the individualist investors, they are more in the long run. So which means that when they take on a bit more aggressive type of investments, they are going to be basically the ones who are going to be sticking it in the long run. Which means that if they take on more aggressive investments, they are the ones who are in a better position to be able to actually sticking in the long run and earn a better return as well. So what you see that when it comes to spontaneous investors, these are the more aggressive type of investors, because remember, they're always looking for the next best thing. But in most cases, they would have actually, by the time that they invest, the investment would have lost steam. So individualist investors, they are more like value investors, where they are prepared to stick to the long run. And because of this, it basically means that if they take on, in most cases, they're going to be taking on investments they are mostly going to be found between moderate to moderately aggressive type of investments in general. So individualist investors, when they take on more risk, they are most likely to be found between moderate to moderately aggressive type of investments, because they are prepared to stick to the long-term investment horizon. But remember, in most cases, because they are researching on their investment portfolio or on their investment portfolio as well that they want to invest in, they are more or less going to be diversifying their portfolio. And remember, when you're diversifying your portfolio, you're not necessarily going to be too aggressive. You're not going to be found on the aggressive side. You're going to be found between the moderate to moderately aggressive type of investment as well. I want same page.
Thank you. Yes.
Any other questions? Any other questions? All right, so let's now go and see exactly how we would link the different personality types to the family members under the in the Inga family as well. So we're going to be trying to link the different personality types to the family members in the Inga family as well, right? So for us to be able to do that, it basically means that we're now going to go back and see exactly what are they telling us about the different family members as well. So we're going to try to see what they're telling us about the different family members. So give me a second to highlight the descriptions of the different family members. So if you go to page 23 of the textbook, if you go to page 23 of the textbook on section 2.3, this is where we're going to start off by analyzing the different personality types there. So can you just quickly read through that and we'll go through together. Can we continue? So first, let's look at Peter's personality typing, isn't it? So here, from the information that we're given that he is a perfectionist and likes to maintain control, right? And now that he is success, he's more concerned with what? Preserving his wealth. So he's consistently been averse to risk, leverage, and change both in his company and his what? Personal life. So Inga has followed a policies of low debt, slow growth, focusing on earnings stability. Like many of his countrymen, Peter holds a portion of his liquid assets in what? Gold bullion as well, right? So what do we see? If you look at Peter's personality type, he wants to be very much in control, right? And at the same time, he's very much less prepared to take on risk. Now, if you go back to the different personality types that we've looked at there, the individuals who are likely to exhibit such personality type are basically the ones that are going to be considered to be what? Are basically the ones that we consider to be so these are the ones that we consider to be methodical type of investors. So with methodical type of investment, they basically follow a method of investment that they need to follow. And at the same time, they're very much afraid of taking risk. So they are risk averse, but at the same time, they have a method that they want to make sure that they follow. And that particular method is basically the philosophy that they're going to be using with all their investment with all their investments as well. So if you look at Peter Inga, his type of personality type would be a methodical investor, because they have an investment portfolio that they always make sure that they follow when they are when they are investing, and at the same time they are afraid of taking on risk. So investors who are afraid of taking on risk and they basically follow a particular investment style when it comes to investments, they are considered to be methodical investors. I'm on the same page when it comes to Peter. Any questions? Next, we look at Peter's wife, and Peter's wife is Hilda. Can you just quickly read through those two paragraphs describing her personality and her goals as well? Hilda's personality type would be described as an individualist type of investor as well. Reason why I would describe her as an individualist type of investor is mainly because they are basically saying that they are individualist type of investors. They are willing to gain information from other people. Remember, methodical investors, whatever they believe is their investment policy, is basically what they always follow all the time. They're not willing to get or to accept information from other people, isn't it? But when it comes to methodical investors, when it comes to individualist type of investors, they are willing to when it comes to individualist type of investors, they are more or less willing to actually what? Get that information, gain information from what? From other people as well. So they are willing to learn and gain information about investments. And at the same time, if you check on the description on Hilda as well, she's even prepared, she's already started actually pursuing other type of investments as well. So what do we see? It basically means that she's more willing to take on risk when it comes to investments. Hence, they are basically saying that she has already what? Started another business. And at the same time, she's willing to be more knowledgeable and becoming more active in what? In investments as well, which means that she's willing to actually what? Learn from other people as well. So those two personality type, those two characteristics are basically what makes Hilda to be an individualist type of what? Investor. Are we on the same page when it comes to Hilda? Any questions? All right, can we move on to their son, Hans? Can we move on to their son, Hans? So what do we see about Hans? If you look at the attitude of Hans, he sees his father as being overly conservative, which means that he's prepared to take on more risks, and he prefers high risk, high return investments. And there also is now he's always going, he's basically looking for the next best thing. As you can see, he's looking to invest in a nightclub in the what? That is scheduled to be opened in the city as well. So what do we see? Hans would be described as a spontaneous investor. So Hans would be described as a spontaneous investor. Reason being, he is what? He is prepared to take on more risk, which means that he's got less risk aversion. So he's got less risk aversion because he's prepared to take on more risk, mainly because he's always going to be looking for what? He is always going to be looking to what? To invest in investments that are able to actually what? And a high return, to invest in what? High return type of investments as well. So it basically means Hans is considered to be a spontaneous investor. Are we on the same page when it comes to the personality type of Hans? Any question? Can we go on to the next member of the family, which is Krista? Can we quickly read through the personality type for Krista and we go through together? Determining a personality type, if you check on this information, they say rents are expensive. However, she needs an assured source of income so that she may focus on her art career. So she's not really that keen on being that heavily involved in the company affairs or the business affairs. But at the same time, she's very much concerned about being able to have an assured source of income. Hence, she wants to be pursuing what? Her art career as well. So what do we see? Krista is a lot more risk averse, and she bases her decisions based on the feeling that she doesn't want to be able to lose any money at all, because she wants to be having a guaranteed source of income as well. So because she's seeking to have a guaranteed source of income, that's why we see that for Krista, we're going to be describing her as a cautious investor, because with Krista, she's not willing to take on more risk at all. So are we on the same page when it comes to the description of the, are we on the same page when it comes to the description of the personality types of these four members of the Inca family? Any questions? When it comes to personality typing, the matrix that is generally used to assess the personality types of different investors is basically something like this, where they say when an investor is more risk averse, and at the same time, they make their decisions based on primarily on what they're thinking and what the investment philosophy that they're thinking should be. We describe these investors as what? Methodical investors. Remember, they are more risk averse, which means that they are very much afraid of what? Taking on more risk. But if these investors who are more risk averse base their decisions primarily on how they feel about the investment philosophy or how they feel about investments in general, then we say these investors, we describe them as what? Cautious investors. Then those investors who are less risk averse, which means that they are more prepared to take on more risk, but at the same time, they base their decisions on what? Primarily on what they are thinking. We say these investors can be described as individualist type of investors. And those investors who are less risk averse, but at the same time, they base their decisions on what they're feeling. We refer to them as what? Spontaneous investors. So this is another matrix that you can also use for you to be able to narrow down to see whether an investor is a methodical investor, a cautious investor, an individualist investor, or a spontaneous investor as well. So they give us the description of the Inga family to see exactly which risk category do they fall under when it comes to those four risk personality, when it comes to those four personality types as well. Where we look at where we said Peter falls under the methodical investor, Hilda falls under individualist type of investor, Hans falls as a spontaneous type of investor, and Krista would be categorized as a cautious type of investor as well. Are there any questions? So when you look at the preparation of the investment policy statement, on page 34, so on page 34, they look at the investment policy statement, and here they say, the investment policy statement is a client-specific summation of the circumstances, objectives, constraints, and policies that govern the relationship between the advisor and the investor. A well-constructed investment policy statement presents the investor's financial objectives, the degree of risk he is or she is willing to take, and any relevant investment constraints that the advisor might consider. It also sets operational guidelines for constructing a portfolio that can be expected to best meet these objectives while remaining in compliance with any constraints. And finally, the investment policy statement establishes a mutually agreed upon basis for portfolio monitoring and review. Then if you skip the next paragraph, they say, the process of writing a thorough policy statement ultimately gives the individual investor greater control over his or her financial destiny. Then on the next paragraph, they also say, finally, the investment policy statement serves as a document of understanding and that protects both the advisor and the individual investor. So please take note of the purpose of why the one has to prepare the investment policy statement as well. Very, very important. So remember we said when it comes to the investment policy statement, you have to look at the risk and return objectives. You have to look at the liquidity. You have to look at the legal and regulatory issues, time constraints, or time horizon, the taxes, and also unique circumstances as well, right? So looking at the return objectives. So under the return objectives on page 35, they say it is important at the outset to distinguish between a return requirement and a return desire. The former refers to the return level necessary to achieve the investment primary or critical long-term financial objectives. The latter denotes a return level associated with the investor's secondary goals. Then on the next paragraph, they say, return requirements are generally driven by annual spending and relatively long-term saving goals. So historically, these goals have been classified as income requirements and growth requirements, with the presumption that the portfolio income is used for current spending and portfolio gains are reinvested for growth. Then if you skip the next paragraph, they say, return requirements are often first presented in nominal terms without adjustments for inflation. Then, as an alternative to growth and income, a total return approach is to setting return requirements, looks for the individual's investment goals, and then identifies the annual after-tax portfolio return necessary to meet those goals as well. Then if you go to the last paragraph under that section, they say, to calculate the return, the required return, and to fully understand the cumulative effects of anticipated changes in income, living expenses, and various stages of life events, an advisor may wish to incorporate a cash flow analysis. So the cash flow statement in Exhibit 2.4 simplistically highlights a 5-year horizon for Peter and Hilda Inga based on information gleaned by Jordan from interviews and background examinations as well. So they give us Exhibit 2.4, which is basically trying to show us exactly how much the total expenses are, and how much, if there's any additions to their current wealth, is going to be when you look at the net additions or withdrawals that they're going to be needing from their current wealth as well. So to understand this better, if you check on the information that is given, this information is coming from the description that we've already been given under the financial statements of the family as well. So currently, the husband Peter, from the company, is earning 500,000, and Hilda is also earning 75,000 from from the trust that has been from the family trust. So which means the total cash inflows that they are having there is 575,000. Are we on the same page when it comes to the cash inflows, how we're getting the cash inflows? Now, from the additional information that we're given, we were told that income tax is levied at 25% and capital gains tax is levied at 15%. Now, with that in mind, it basically means that because they've not sold any of they have not sold their businesses yet currently, it means that there's no capital gains tax, but the type of tax that they're going to be charged there is the 25% income tax. And if they're going to be charged 25% income tax, it means the 25% of 575,000 is going to be the income tax that they're currently paying. Then, on top of this as well, remember they say their living expenses are currently 500,000. So their living expenses are currently 500,000, which means the total expenses currently are 500,000 plus 143,750, which gives you a total expense figure of 643,750 there. So do you see where the total expense figure is coming from? Are we on the same page on exactly where this figure is coming from? Is anyone lost on that? So which means if the total expenses are 643,750 and the total inflows is 575,000, it means that on their overall investment, they are making a net withdrawal of 68,750. So it means that from the overall investment, they need to be they are currently making a net withdrawal of 68,750. Are we on the same page on where this figure is coming from? Is anyone lost on that particular figure? Now, remember we're saying that currently now, after this year, the Inga family, they are planning to actually sell their business. So they are planning to sell their business, and when they sell their business, they are also estimating to actually they are also estimating to make money from selling their business as well. So which means in this case, what do we see? They are telling us that for Hilda, the money or the income that she's going to be generating from the trust is going to be growing by By inflation rate of 3%. Remember we said Real rate of interest is 3%. The inflation rate is 3%, which gives you a nominal growth rate of what? Of 6%. So if the income on the trust is going to be growing by inflation adjustment, it basically means that if the income currently is 75,000, it basically means that your cash flow in period 1 is given as the cash flow in period 0 in bracket 1 plus growth rate. So the cash flow in period 1 is given as the cash flow in period 0 multiplied by 1 plus the growth rate. So which means if you want to find out exactly how much the cash flow that yield is going to be earning in this in the first year or after 1 year, is going to be, currently she's earning 75,000, and that cash flow is going to be growing by what? By 3%. So if this is the case, how much is she going to be earning after what, in the first year? So how much will she be earning in the first year? How much do you get?
$77,250.
So it will be 77,250, isn't it? Then, so this is how we are able to now estimate to see exactly how much the cash flow is going to be in the next year. So when you try and find out exactly in the next year as well, you take this figure, then you say multiply by what? 1 plus the growth rate. And that's how you're going to be able to estimate the cash flows going into the future as well. So which means the cash flow that she's going to be expecting to be earning from a family trust going to the future is going to be what? Based on that. I'm on the same page on where I will be able to get the payments from the trust. Is anyone lost there? Now, next, so which means that the payments from the trusts are going to be based on what? Are going to be growing by 3% until the next 5 years, where we're saying that after this, there's going to be a total change from the what? From their portfolio as well. Then we are also told that Peter is planning to give himself a pension amount of 100,000 annually from year 5 onwards. So that's why you see that the annual amount of 100,000 there. So Peter is planning to give himself an annual amount of 100,000. Remember we said that Peter is going to be earning that amount of 100,000. That is going to be what? A fixed annual payment that is going to be earning from year 5 onwards as well. So the 100,000 is basically what Peter is basically going to be giving himself is what? Pension income from year 5 onwards. Then Peter also have what we call an RSA investment. And from this RSA investment is expecting to be earning a fixed amount of 5,000 3 years from now as well. So from year 3 onwards, he's expecting to be earning 5,000 from this particular investment. Then at the same time, if you check on the stake that Peter holds, if you check on the family stake that Peter holds, you will see that if you check on the family stake that Peter holds, let me just quickly check. I will highlight quickly now. Where's the financial statement? So if you check on the financial statements, you see that in the family business, Peter has got equity worth 60 million. And his wife, Hilda, is equity worth 1.2 million in the family business. So when you're now looking at your fight, but the analyzing remember the whole idea of this exercise is that you're trying to find out exactly, so how much is the return requirement that they need for them to be able to live on their on their investment they're going to the future as well. So here we see that Peter is having an equity share of 60 million, and his wife Hilda is having an equity share of what? 1.2 billion there. So based on this, it basically means when you're now trying to find out exactly how much is the total value of your investment, if you're trying to find out exactly how much the total value of your investment would be, That's why you see that when they sell the company, or if the equity stake in the company, that's why we're estimating that if they sell their equity stake in the company, they are going to be able to have how much? 61.2 million. We're estimating that they'll be having what? 61.2 million when they sell their equity stake in the company. So which means now this is how we're going to be able to get the total cash inflows from year 1, year 2, year 3, year 4, and year 5. Like for example, for year 5, the total cash inflow is going to be 86 plus 100 plus 5,000, which gives you a total amount of what? 191,946. Are we on the same page when it comes to the total cash inflows there? Anyone lost? Now we are going to now go on and look at what? The cash outflows. And when we look at the cash outflows, remember the cash outflows are going to be based on the income that is expected to be generated by the couple, isn't it? So what do we see? The income, the 25% tax rate is going to be levied for year 1 on the 77,250. And in year 2 is going to be levied on 79,568. And in year 3 is going to be levied on 81,955. And in year 4 is going to be levied on 84,514. And in year 5 is going to be levied on 86,954 plus 100,000. Because remember, these 5,000 income there, we're not going to be levying any tax on them because they are considered to be what? To be tax-free. So this is how we are going to be able to calculate the income taxes there. Is anyone lost on how we are calculating the income tax? Then the capital gains tax is going to be levied on the 61,200 sale of the equity capital. Remember, they started the business with nothing, but now after so many years, they are now deciding to sell the business. So the business is actually has achieved what? Capital gains. So the capital gains there is the 61,200 that they're going to be 61.2 million that they're going to be selling their business on, which means that 15% of the 61.2 million is basically the capital gains that are going to be charged, that is going to be charged on them. And the capital gains in this case is going to be what? 9,180,000. Are we on the same page on how we're getting the capital gains tax then? Then they also tell us that in the first year, they want to be able to buy a home for themselves, where they say that they want to be able to buy the home, and for the particular home, they want it to be able to be accessible, and they want it to be in the magazines as well. And they're going to be planning to spend an amount of what? 7 million. And they also say they want to be able to invest in a magazine, and they're expecting that the investment in the magazine is going to cost them how much? 5 million as well. Then they are also expecting that from year 1 onwards, with the next year onwards, they want to be more actively involved in their grandchild, and as they're getting more actively involved in their grandchild as well, they are basically expecting to be what? To be spending 15,000, which is also going to be growing based on what? Inflation adjustment, which means that it's going to be growing by what? By 3%, like what we did with the calculation for what? For payments from the trust as well. So these payments or contributions or donations to their grandchild are going to be growing by 15% as well. So which means, remember they say wealth transfer is going to be what? Is going to be charged 50%, or 50% is levied on any wealth transfer, isn't it? So 50%, for example, in the first year, 50% of 15,000 is basically the wealth transfer tax that they're going to pay. And in the second year, 50% of the 15,000 is the wealth transfer tax that they're going to pay, and so on and so on and so on and so on. Which basically means that, and at the same time, they are also expecting that their living expenses are going to be growing by what? By inflation rate as well. So they are going to be growing by inflation rate. As you can see, the living expenses are also going to be growing by that. And this is how, so which means that in the first year, their total expenses are going to be the total of what? Of these expenses. So this is where they're getting their total expenses. And if their total expenses is this, and the total inflows is this, what do we see? It basically means that there's going to be a net cash inflow of how much? Of this amount. And in the second year, this is the total cash. This is the total cash inflow that they have. And at the same time, this is the total cash outflow that they're also anticipating. Sorry, this is the total cash outflow that they're anticipating. So it basically means that there's going to be a net cash outflow or withdrawal need of 493,948,949. And then the same for year 3, the same for year 4, and the same for year 5. Are we on the same page on this particular exhibit before we go on further with assessing to see exactly how would they calculate the average income needs as well, or the real rate of return that they want the investment to be able to earn? Are we on the same page before we go on to see how they can be able to calculate the return requirement on the investment? So these are the withdrawal, these are the amounts that they're going to be able to, the withdrawal needs that they need, isn't it? Now, the next issue that I'm going to be looking at before, remember we said these are the total withdrawal amounts that they're going to be needing to withdraw, isn't it? Now, the next issue that we need to be able to look at is to see exactly how much their investable assets are worth. So we need to find out exactly how much the investable asset would be worth. So if you want to find out exactly what the withdrawal need is going to be, or the return requirement is going to be in the first year, we're now going to say, when it comes to their assets, in the first year, they are going to be sitting with a cash inflow of 39,540,437. So this is the net cash inflow that they're going to be having in the first year. And in the first year, the other investable asset that they have is the stock holding of 750,000, fixed income holding of 1 million, cash and cash equivalent of 1 million, and that RSA account, which is going to be sitting with what? 50,000. So which means their total investable assets is an amount of 42,340,437. So based on this, if ever they ask you to calculate the return requirement, for example, in the first year, the return requirement is going to be equal to, so the return requirement, is given as the withdrawal needs divided by the value of the investable assets. So the withdrawal needs divided by the value of the investable assets would give you what the return requirement would be. So the withdrawal needs divided by the value of the investable assets, and this is how you're going to be able to determine to see exactly how much the return requirement would be if they ask you to find the return requirement on that particular portfolio. So if you check on the information that they give you, if you check on page 36, if you check right at the bottom of page 36, I'll highlight it quickly now. If you check right at the bottom of page 6, say the net cash flows for so they say the net cash flows for Peter and Hilda conveniently stabilize in year 2 and decline in year 5. So consequently, we can estimate their after-tax return requirement in Exhibit 2.5 by dividing the projected needs in year 2 by their net investable assets at the end of year 1. So in this case, the investable, the need for withdrawals in year 2 is what we're giving as what? This amount of 493,949. And the investable assets at the end of year one, we already done the calculation below, where we saw that the value of the investable assets 42,340, 437. So because of this, it basically means that the return requirement would be estimated to be equal to 1.17%. So this is basically how we're estimating the return requirement to be equal to what? 1.17%. Are we on the same page then? So the return requirement would be equal to 1.17%. But then they also go further and say, additional to the current annual inflation of 3% to 1.17% results in an approximate after-tax nominal return objective of how much? 4.17. So the after-tax return objective is going to be equal to the real rate of return, the real return objective of 1.1%, 1.17% plus the expected inflation rate of what? Of 3%. And this is how they are getting an approximated after-tax nominal return objective of what? 4.17% there. Are we on the same page on how we're getting this return objective of 4.17%? Is anyone lost on this? Now that you would have been able to estimate the return requirement, you can now go on and also look at the risk objective as well. So we have now looked at the return objective. We can now be able to actually account for the risk objective. So in accounting for the risk objective, remember we said that there's always going to be two things that you need to take into account: the ability to take risk and the willingness to take risk. Then you also now look at what? The overall assessment on what? On the overall risk rating for what? For the particular client as well. So when you look at the risk objective, under ability to take risk, the question that you need to be able to address, if you check on page 37, they say the question that you need to be able to address is one, what are the investors' financial needs, goals, both long-term and short-term? And if you look at these particular clients as well, they tell us that for Peter and Hilda Inga, investment objectives are primarily short to intermediate term in nature. So their investment objectives are basically to support for current lifestyle, construction of a second home, investment in exteriors, support of Jürgen's education, and expansion of Hilda's design company as well. Then the next question that you have to ask yourself, or ask the investor, is how important are these goals and how serious are the consequences of them not being met as well? So which means if you check here, they say beyond assuring their financial security, the Inga investment goals appear important but perhaps not critical. The second home is important to both Peter and Hilda and will play a major role in defining their future lifestyle. So similarly, Peter's investment in exteriors is not driven by economic needs, but it will play an important role in the life of of their in sale of the Inga Marine as well. Then the next question would be to ask how large an investment shortfall can investors' portfolio bear before jeopardizing the ability to meet major short-term and long-term investment goals. And yet they say the limit of the portfolio's ability to accept risk is reached when the probability of failing to meet a high priority objective becomes unacceptably high. So the investment advisor can provide guidance with probability estimates and identify clearly unrealistic expectations, but the ultimate determination of acceptable will also depend on the investors' general willingness to accept risk. So after this, so remember I said here we first looked at the ability of the investor to take risk. The second issue that needs to be addressed is the investor's willingness to take risk as well. And here they say, in contrast to ability to take risk, investors' willingness involves a more subjective assessment. No absolute measure of willingness exists, nor does any assurance that willingness will remain constant throughout time. So psychological profiling provides estimates of an individual's willingness to take risk, but final determination remains an imprecise science as well. So these are the issues that we need to be able to address, that for us to be able to now address, come up with a conclusion to say, overall, how is the overall risk assessment of a particular investment client as well. Next, we look at the constraints. Remember, we said the return objective and the risk objective, we consider to be what? They are objectives, isn't it? Now we're going to be looking at what? Constraints. And the constraints that we're going to be looking at here, they say the investment policy statement should identify all economic operational constraints on the investment portfolio. So portfolio constraints generally fall into one of the 5 categories: liquidity, time horizon, taxes, legal and regulatory environment, and unique circumstances. So now, when it comes to liquidity, they say liquidity refers generally to the investment portfolio's ability to efficiently meet an investor's anticipated and unanticipated demands for cash distribution. So 2 trading characteristics of a trading of holding determine a portfolio's liquidity: the transaction cost and the price volatility. So the lower the transaction cost, the more liquid a portfolio can be considered to be as well. Then the higher the price volatility, the lower the liquidity a portfolio would be. So ideally, you want a portfolio where the transaction costs are low, the price volatility is also low, and that portfolio can now be considered to be high behaving affected by low liquidity, because it's easier now to actually move in between portfolios, or move in between assets in a portfolio without incurring huge losses as well. So under liquidity, they say on the next paragraph, significant liquidity requirements constrain the investor's ability to bear risk. So liquidity requirements can arise for many number of reasons, but generally fall into one of the following 3 categories: ongoing expenses, emergency reserves, and negative liquidity events. So here they say the ongoing costs of daily living create a predictable need for cash and constitute one of the investment portfolio's high priorities. So the more the ongoing expense that you need to meet, the lower the liquidity of your portfolio. And at the same time, if you don't have an emergency reserve, the lesser the emergency reserve you have, the more liquidity you are going to be able to, the lesser the liquidity your portfolio is going to be. So ideally, the idea would be you need to be able to create an emergency reserve, so that if there's any need for any cash that you need to be able to withdraw, it's going to be taken out from the emergency reserve, and not taken out from the investment portfolio as well. And any negative liquidity events are going to end up affecting the liquidity of your portfolio as well. So which means that all these events all these factors are the ones that are going to be affecting the liquidity of your portfolio. Then they also talk about illiquid holdings, and yet they say to ensure that all parties have a complete understanding of portfolio liquidity, the investment policy statement should specifically identify significant holdings of illiquid assets and describe their role in the investment portfolio. So examples might include real estate, limited partnership, common stock with trading restrictions, and assets burdened by pending litigation as well. So which means whenever you're preparing your investment policy statement, you also need to be able to distinguish between investable assets and non-investable assets. Because remember, in most cases, those assets that are basically investable but not easily converted into cash, you need to be able to state them as part of your illiquid holding as well. The next issue that needs to be addressed is the time horizon. And yet they say the investment time horizon has already been seen to play an important role in setting return objectives and defining liquidity constraints. So no universal definition of long-term or short-term exists. However, and discussion is often left in relative what rather than absolute terms. And secondly, a second issue relating to the investment time horizon is whether the investor faces a single stage or multi-stage. Then on the next paragraph, they say, stage of life classifications, as discussed earlier, often assume that the investment time horizon shortens gradually as investors move through the various stages of life. So although this assumption may not always be true, it is not always. It's often true, it is not always what? True. Then if you skip the next sentence, they say the advisor's clients may be advanced in years, yet the planning of their grandchildren, or it may be the grandchildren personal circumstances that determine the investment portfolio's goals and time horizon as well. Like for example, if they've already created a trust for their children as well, it basically means that the time horizon is not necessarily going to be restricted by the people who have created the trust for their children. It's now going to be dependent on exactly what are the terms and conditions of the trust, which means that it's now going to be dependent on on the beneficiaries on the beneficiary's life stage as well. The next issue that needs to be addressed is the issue of taxes, where they say the issue of taxes is perhaps the most universal and complex investment constraint to be found in private portfolio management. And if you skip the next sentence, they say, although tax codes are necessarily country specific, the following general categories are widely categorized. So which means when you're looking at tax issues, you need to take into account income tax to see exactly what is the income tax levied on individuals as well. Then you also have to take into account capital gains tax, and you also have to take into account wealth transfer tax as well. So when you're looking at tax issues, those are the four types of tax that you have to take into account. Like for example, in this case, you also have to take into account property taxes as well. So when it comes to tax issues, these are the four tax issues that you need to be on the lookout for when it comes to advising the client when you're preparing the investment policy statement. Another tax issue that you can also advise the client on is the issue of tax deferral. Because remember, when you're now advising the client, you can now be able to play around with the different tax issues so that you're able to actually reduce their burden on the tax that they have to be that is going to be levied on them as well. So when it comes to tax deferral, as I say, for the long-term investor, periodic tax payments severely diminish the benefit of compounding portfolio returns. So many tax strategies therefore seek to defer taxes and minimize the time during which the investment returns can be reinvested. So when it comes to tax deferral, this is where, when it comes to tax issues, when you're advising your client on the tax issues, this is where if you see that the income tax generally is higher, like for example, than the capital gains tax, what are you going to do? You would rather advise your client to not earn dividends on the investment or not to earn interest income on the investment, because the income tax is going to be generally higher for them. So they can defer tax by reinvesting that income within the businesses or investing in assets that reinvest the income, so that they are only going to be levied taxes when they eventually withdraw from the overall investment as well. Another advice that they can also do, that you can also give them, is tax avoidance, where they say the ideal solution is to avoid taxes when legally possible. And remember, tax avoidance is legal and tax evasion is the one that is illegal as well. So you have to make sure that you're able to give them advice on exactly how they can also be able to actually avoid taxes as well. Like for example, if there's any other tax concessions that are available, which means that way they're going to be able to actually take advantage of them as well. Then there's also issue of tax reduction, where they say if taxes cannot be avoided entirely, opportunities may remain to reduce their impact. Their income tax rates exceed when the income tax rate exceed the capital gains tax, as they do in a number of countries, then it would mean a portfolio manager may emphasize securities and investment strategies whose investment returns are recognized as gains rather than as what? As income. So which means that they would rather invest in investments where they are not going to be earning any income at all. The only investment that they're going to be earning there are basically those investments that they're going to be investing in are those investments where there is no income that is generated, but at the same time they're going to be earning what? They're going to be taxed only on capital gains tax that is going to be levied in what? When they eventually disinvest as well. Then another issue that they have to take into account is the wealth transfer tax to see exactly what is the impact on wealth transfer tax that is going to be levied as well. So they have to take into account to see exactly how are we going to be able to reduce the impact of wealth transfer taxes. Like for example, if you look at the case of South Africa as well, there are tax concessions that are also made available where for wealth transfer tax, there's going to be limitations of 100,000 on an annual basis. That is considered what? Tax-free when it comes to wealth transfer. So when it comes to wealth transfer tax, it basically means that you now have to take into account to see exactly how are you going to be able to look at and play around with wealth transfer taxes either before death or after death as well. Where they say, if you check on the next paragraph, they say transfer at death. If the investor pursues no other strategy, a wealth transfer tax may be assessed at death, which means that, like for example, on the overall effect, on the overall estate there, before they are going to be calculating to see exactly how much is going to be the estate duty, and that particular estate duty is basically what? The transfer tax that's going to be levied at what? Upon death of the individual or the investor as well. Then there's also any transfers that can also happen, where they say accelerated wealth transfers or philanthropic gifting may be desirable when the investor wishes to maximize the amount of his or his estate after taxes that are passed on what? Onto the individuals or organizations as well. Then we also look at the legal and regulatory issues as well. And when it comes to legal and regulatory issues, they say in the context of portfolio management for individual investors, legal and regulatory constraints are mostly frequently involve taxation and the transfer of personal property ownership. Then if you skip the next two sentences, they say, whatever a portfolio manager's level of legal and regulatory understanding, she must be careful to avoid giving advice that would constitute what? Practice of law. So which means that in this case, when it comes to the legal and regulatory issues, avoid having to give legal issues that basically you are not what certified what to give advice on as well. Then under this as well, the legal and regulatory issues that you have to take into account are basically going to be pertaining the different what jurisdictions that you have to bear in mind as well. Like for example, when it comes to personal trusts, and under that, on the last sentence of that paragraph, they say a trust is a legal entity established on holding and managing assets in accordance with what specific instructions. So the term personal trust refers to the trust established by an individual who is called the grantor. The trust is recognized, or the trust is a recognized owner of assets and can be subject to taxation in much as the same manner as individuals are taxed as well. Then another way that the money can also be transferred, or the wealth can also be transferred, is through family foundations. And here they say civil law countries as found in continental Europe are characterized by the existence of what? Family foundations. And here they say similar to an irrevocable trust, the foundation is an independent entity often governed by family members. Such foundations can be part of multi-generation estate plan and often serve as a vehicle for introducing younger family members into the process of what? Managing family assets. So which means in this case, how you be able to transfer the wealth when it comes through family transition foundations, you're going to be able, this will be able to, this can be able to enable the facilitation of what? Gifting to grandchildren, where they say, for example, in this case, Yagin is currently too young to receive large direct gifts, but an irrevocable trust might be established what? For his benefit as well, if you are considering what? Gifting to children. And on page 47, they also say, when you look at gifting to children, this can also be done through unconditional transfer of what? Family wealth as well. And this can also be done through creation of a trust or a foundation. And then the gifting with retained interest, this is where the various options exist for creating hybrid structures that provide immediate support for one party, but ultimately distribute their assets to a second party as well. Like, for example, gifting with retained interest, this is where one can be given to say, we are creating this trust, but this person is going to be able to enjoy the benefits of this trust until they die. Then upon their death, the remaining assets on the trust can be transferred to another given or stated person as well. Then you also have to consider what? Jurisdiction. And here they say individual investors may enjoy a limited degree of flexibility in determining the jurisdiction in which their income and assets may be taxed. So, like, for example, you look at offshore, this is where you say offshore investments in trusts in a tax-friendly countries typically offer some measure of enhanced privacy, asset protection, and estate planning advantages, as well as what? Possible opportunity to reduce tax liabilities as well. So when you're also looking at transfer of wealth as well, you also have to consider the jurisdiction in which the investment is going to be done as well. Where sometimes you can also consider investing or pushing your money offshore where they are tax friendly or tax havens, where you know that when you're now transferring the wealth there from you to the individuals, it's not going to be that much affected by the effect of taxes as well. Then the last constraint that you have to take into account would be unique circumstances, where they say, not surprisingly, individual investors often present their investment advisors with a wide range of unique circumstances that act to constrain portfolio choices. So some constraints might include guidelines for social and special purpose investing, assets legally restricted from sale, directed brokerage arrangements, and privacy concerns. So it is also appropriate to list here any asset held outside the investment portfolio and not otherwise discussed in the investment policy statement. So any other constraints which are not falling under any of the four above constraints there, they can also fall under unique circumstances as well. So are there any questions before we go on to see how ideally the investment policy statement for the Inga family would be prepared? So are there any questions before we go into the investment policy statement for the Inga family? Any questions? So the preparation of the investment policy statement for the Inga family can be prepared as follows. So you can first look at the background where they say here, Peter and Hilda Inga own and operate an Inga Marine, a producer of luxury pleasure boats sold worldwide. So the Ingas are eager to convert their equity stake in Inga Marine to cash and receive bids indicating probable proceeds to Peter and Hilda of 52 million net of taxes. So they consider everyone in their family to be financially secure and wish to preserve that security. So the Inga family consists of their son Hans, daughter Krista, and grandson Jürgen. Hans is a senior vice president of Inga Marine, specializing in design. Krista is an artist and single mother to Jürgen as well. So this is basically the background information to when you're preparing the investment policy statement. But remember now, from the background information, now you have to look at the return objectives. And here they say, longer term, the Ingas wish to assure not only their own financial security and standard of living, but that of their grandchildren as well. So the investment portfolio must replace Peter's salary, which greatly covers the couple's annual expenses and gifting. So it should also provide a return sufficient to offset the effect of inflation as well, which is 3%, and which is ultimately their grandchildren's inheritance. So when you're now looking at your return objectives, we look at the required return, where we say when you look at year one's withdrawal needs, this is the withdrawal need. And when you look at year one's investable assets, these are the estimation of the investable assets in year one, and this is how you're able to determine the return requirement of 1.17%. Then the expected inflation is 3%, which means that the return objective for the Inga family in this case is going to be 4.1%. So this is how we're able to estimate the return objectives for the family being 4.17%. Is there any question when it comes to the return objectives before we go on to the risk objective as well. So when it comes to the risk objective, we see that we look at the ability to take risk, then we also look at the willingness to take risk as well. And when they assess the ability to take risk, they say, following the sale of Inga Marine, the Inga's investment portfolio will be able to accommodate considerable volatility without endangering its ability to meet their financial objectives. So given Peter and Hilda's cash flow circumstances, they are likely worth position after the Inga Marine sale and their post-retirement objectives. Their ability to take risk appears to be above average. So first, we have to assess the ability to take risk. So first, we have to look at the ability to take risk in this case. Then we also look at the willingness to take risk. And here they say the Ingas are relatively conservative by nature. Personality typing of the Ingas identifies Peter as methodical and Hilda as individualist. So Peter seems to have managed Inga Marine with a bias towards low debt, stable earning rather than rapid expansion. So the Inga historically held a large portion of their liquid assets in money market accounts. So furthermore, the Ingas do not want to a portfolio value decline that is more than 10% in nominal terms in any given 12-month period. So their willingness to take risk is generally below average. So the willingness to take risk is generally below average. Then they also say to reconcile the portfolio's considerable ability to accommodate risk and the Ingas' apparent preference for lower risk, their overall risk tolerance is described in their policy statement as what? Moderate to average. So when it comes to the issue of the risk tolerance when it comes to preparation of the investment policy statement, generally, what I've seen over the years is that always make sure that you make an advice or your overall assessment is always going to be found between below average to just above average, so that your overall so this is basically the range of your assessment that you have seen the recommendations basically falling under. Being or having an overall assessment of conservative, it takes a lot for one to be able to overly being what considered what having a conservative risk assessment. So if you see that the ability to take risk is low, the willingness to take risk is low, that's when you can that's when you can recommend what a conservative risk rating. At the same time, if you see that the ability to take risk is very high, and if you see that the willingness to take risk is very high, that's when you can consider an above average to aggressive risk rating on the overall portfolio. But generally, the risk rating falls on the moderate or average risk rating in most cases that I've seen over time as well. So this is basically the cheat that you can also use when you're assessing what the risk rating of the different investors as well. Next, we look at the liquidity constraints. And when you look at the constraints, which is, well, firstly, we look at the liquidity constraints. They say the Ingas have multiple short to immediate long-term liquidity constraints. The first one is to build their house that they want to be able to, that they want to have, which is worth 7 million, and they want to take out 7 million for that. They want to invest in exteriors for a total amount of 5 million. They want to keep an emergency reserve of 1 million. They also want to be able to meet the annual expenses that they want to maintain of 500,000. They want to be able to support their grandchild before you take into account inflation for 15,000. And at the same time, they are also having illiquid holdings or illiquid investment that they're also having as well, which basically affects what? The liquidity of their overall portfolio. Where they say the Inga Marine currently represents a disproportionately large and illiquid part of the Inga net worth, mainly because the investment in the company is basically not is basically a highly illiquid asset unless they're able to actually be able to sell that investment as well. Then they also say after the sale of the Inga Marine and construction of their second home, and the Ingas might have approximately 16% of their net worth committed in personal residences, where they are now saying that, remember, they are having currently a house which is worth about 1.2 million, and another resident that the house they want to build currently, which is worth what 7 million as well. So which basically means that these are the factors that are going to be affecting what their liquidity of their overall portfolio. Then when it comes to the time horizon, they say aside from the liquidity events listed above, the INGAs have a long-term multi-stage time horizon, mainly because they are able to withdraw money over time. And at the same time, the first time horizon is between now until they retire. Then after that, they're also going to be looking at what post-retirement stage as well, which basically means that they're having a multi-stage time horizon as well. The tax issues, they say the INGAs are subject to their country's tax code and wish to pursue strategies that maximize what the wealth passed to their children as well. Then when it comes to legal and regulatory environment, they are basically saying that any RSA created by the INGAs must be managed in compliance with the prevailing fiduciary standards and the diversification of what and prudence as well. Then, under unique circumstances, this is where you're now going to be looking at what you are any other constraints which are unique, which cannot be categorized either liquidity, legal, time, or tax constraints as well. And in this case, when it comes to the INGA family, the first unique circumstance they have to take into account is the critical. They say the critical component of the Peter and Hilda retirement plan is the disposition of the INGA stock to a willing buyer. So this situation should be continually monitored to ensure that the assumption made in any plan remain valid. Second one, the INGA second home will represent an illiquid portion of their total net worth. So they have discussed the possible risk and they have decided not to consider the home as what part of their actively managed what investment portfolio. So the second home will not carry a mortgage as well. So which means that that's another unique circumstance as well. The third one is they have to take into account the estate planning consideration, where they say the gift to the children, that is the INGA will consider various means of tax efficiently securing the children's financial security, including outright gifts and creation of special purpose trusts and foundations, charitable gifts, and in addition, to outright gifts, the INGAs will consider what special purpose trusts or foundations, naming selected charities to remain and family members as what income beneficiaries as well. Then the fourth one, the complex family changes that are about to occur suggest the need for increased flexibility in whatever investment strategy is updated to accommodate potentially frequent and abrupt shifts in attitudes and circumstances as well. And the fifth one is the INGAs want only limited exposure to common stock investment because of their retirement situation as well. And the sixth one is the INGAs want to maintain a fixed long-term holding of 500,000 in gold bullion. So they're going to be able to actually you need to be able to state this as part of the unique circumstances as well. So are there any questions? Are there any questions when it comes to the issue of the investment policy statement and how to prepare the investment policy statement as well? Are there any issues? Any questions? So if there are, yes.
With regard to, I think it was the statement of cash flow, right? Was it
Sorry?
the statement of cash flow? The statement of cash flow we did earlier on. Are we expected to do that before we advance to the investment policy statement?
You mean the cash flow statement? Let me just quickly go back to the cash flow statement that I'm suspecting that you are discussing. Do you mean this cash flow statement here? This cash flow statement? Are you referring to this exhibit 2.4, this cash flow statement on exhibit 2.4?
Yes.
Yes. In some cases where they ask you to determine the return objectives, they would ask you to prepare the cash flow statement as well. So I've seen some questions in past assignments and in past papers where they ask you to prepare this cash flow statement. But in most cases where you are going to be preparing for one stated period, not as many as they are giving us here, usually you prepare for one period or two periods Then based on this, this will now give you to see exactly how much the withdrawals are going to be. Then after this,
so
you also need to be able to determine to see exactly how much the investable assets you have. And the reason why you need to do that is because you overall need to be able to prepare the what to determine the return requirement at the end of the day. So to get the return requirement, you need to be able to prepare this cash flow statement as well.
Okay, thank you. So are we going to be given a specific template to do that?
So the cash flow statement is now going to be very subjective, but overall, the cash flow statement is just going to be based on the expected inflows and outflows of cash. So we're just going to be looking to see exactly going into the future, what are the inflows that I'm expecting based on the case study, and what are the outflows that I'm going to be expecting based on what? Based on the case study. It's very, very subjective. So there's no set template that they would give you.
Okay, thank you.
All right. Any other questions?